Hey, welcome back. I want to provide this episode giving you a rather interesting clip that I found from a crypto expert giving his clear-cut explanation what is a blockchain at a congressional hearing in the United States. I found it very interesting, and it really clarifies that for potential investors who are thinking about investing in blockchain. So I encourage you to watch this 5-minute clip in its entirety because it really provides that clear-cut explanation and the benefits that it provides to society. And then later on towards the end, I will give my final takeaways and thoughts as a roundup to today's episode. So enjoy the clip.
Mr. Brooks, let's step back from digital assets and blockchain for a moment. Let's talk about where the internet was, where it's come to, where it's going, right? We're trying to level set here for policymakers. So originally, the internet was a read-only format, in essence. We're consuming information. And then there's additional layers that we place on. It became much more interactive. But counterintuitively, much more interactive, but much more centralized in Web 1, Web 2. What we're hearing now is Web 3. Policymakers need to understand the nature of Web 3. This is a hearing about a component of Web 3. Now, along those lines, what are the characteristics that defined Web 1 and Web 2?
Mr. McHenry, thank you very much for that question. I think that's critical to understanding what we're all trying to build here. So the characteristic of Web 1, if people remember their original AOL account, was an ability to look in a curated walled garden at a set of content that was not interactive but was presented to you on AOL the way that Time magazine used to show you the articles they wanted you to see inside of their magazine. Just you could see it on a screen. The innovation of Web 2 was that suddenly you could not only read content, but you could also write content. This is when the blogosphere became a big thing. People remember this from the late 90s, the early 2000s. The reason for the centralization of the internet, of course, was that all of that activity was being monetized by a very small number of companies. Facebook, as the chairwoman mentions, Google, and 2 or 3 other companies. What makes Web3 different is the ability to own the actual network. And that's what crypto assets themselves represent, is an ownership stake in an underlying network. So when you hear people talk about, for example, layer 1 tokens, what they mean is this is your reward for providing the ledger maintenance services, the computing power to the network that on Web 1 and 2 was done by Google, right? So now people in my hometown of Pueblo, Colorado can actually own the Ethereum network, but they can't own the internet. That's owned by Google and a few other companies. That's what the project of crypto is all about, is allowing people to directly own the networks that have native assets that are supporting it, and that's the nature of decentralization, where the token holders are the people who control the asset, not
so
Google.
Token holders, for our language here on the Hill, those are digital assets, right? Which are the keys to open up the ledger for you to participate, right?
Correct.
So describe to us how those digital assets fit into this internet revolution, Web 3.
So the concept is that you have sort of application layer tokens and you have protocol layer tokens. So if I'm an owner of Bitcoin, let's say that I'm a miner of Bitcoin, somebody who actually creates Bitcoin. The Bitcoin is the reward I receive for doing the work to keep the network operational, and that allows me to own a piece of the Bitcoin blockchain. Or take Ethereum, which is easier to understand. The Ether token represents an ownership stake in the network, but on top of that network are all kinds of apps that get built on the network, much like the apps on your phone depend on the underlying network existing that lets the phone operate. And so people will make judgments about which network is likely to win, and they will invest in the tokens in that network much the same way you might invest in Google stock because you think Google is going to scale access to the original internet. The difference being here, you can vote on what happens in the future of a proof of stake network, for example. You can get rewarded through a proof of work token for maintaining a ledger on something like Bitcoin. But the real message here is that what happens on the decentralized internet is decided by the investors, versus what happens on the main internet is decided by Twitter, Facebook, Google, and a small number of other companies.
Okay, so getting this layer on digital assets right, for Congress to understand this, everything is built upon that on-ramp to this new internet. So very important for us to be sensitive to how this develops and any actions we take in terms of laws and updating laws to incorporate these new technologies.
Yeah, Mr. McHenry, couldn't agree more. And I think when you hear about all of the problems of different big tech companies, the importance of an owner-controlled network becomes clear.
Okay, owner-controlled network rather than a cooperative, right? And
Yes.
thinking in those terms.
Absolutely.
Right? So if you're not a part of management, you're not making a decision in Web 2. If you are a participant in the network, you're cooperating in the making of those decisions.
Exactly right.
Okay. So I ask this not to be insulting to the panel, but to have a level set here so we have an understanding of what we're talking about. This is not simply about you on this panel. It is about trillions of dollars of assets that did not exist before Satoshi wrote his white paper 13 years ago. It's about $3 trillion in notional value at this stage around the development of a whole new range, a whole new suite of technology that will be developed across the globe, whether or not the United States embraces it and wants to compete, or if it's pushed offshore. So as policymakers...
So as this gentleman explained at the Congressional hearing on what is the blockchain and the benefits that it can provide to society is really clear. And just as it does stop there in terms of users being given the opportunity for the first time to own a proportionate amount of the public internet for the purpose of running a blockchain public ledger, and in return they receive crypto assets as a reward for providing maintenance services for the upkeep of the blockchain network. But in addition to that, there are numerous other benefits. It's immutability, so it means that once you write or commit transactions onto the blockchain network or to the public ledger therein, it persists through time. You cannot change it. It's mathematically impossible to unravel the transactions once they're committed onto the public ledger. It's impossible. So that is an additional benefit over and above what we typically see in privately run corporate databases, whether it's in a bank or in a company or even indeed at a government, where they do have that propensity and temptation to undo user transactions on their databases. That is a fundamental difference, but it just doesn't stop there. We have things like security. Also, it enables privacy of those transactions. And also, I think what's most important, if you were to ask me, what is the unique attribute that blockchain provides from an investment standpoint, is the notion of fractional ownership. So if you think about, and I made several videos on my channel, which is the reason why you ought to subscribe to my channel to dig deep into this area, is within the realm of real world assets tokenization, which is the next wave of blockchain technology. For the first time, users are able to participate and invest in tokenized physical assets on the blockchain. So things like premium real estate, arts and collectibles, financial instruments, even basketball teams, football teams, anything that has an intrinsic economic value attached. Investors are able to invest from a fractional ownership perspective. So they can own small bits of the tokenized assets on the blockchain, which is very different. So if you think about, let's say, a first-time buyer who is looking to buy their first home in the physical analog world, well, they have to put a hefty deposit, typically 5 to 10%, depending where you are. And if you compare that with the premium real estate that gets tokenized on the blockchain, where you don't need to worry about that, you can put in as little as a cent of a dollar to several hundred, depending on your risk appetite. That is the fundamental difference. And that enables the investors of the blockchain, of these tokenized assets, to participate and own portions of that tokenized asset through these tokens that they will receive as a result of their investment. That is the opportunity, and it's set to grow. I made another video on real world assets tokenization, quite a few, where Boston Consulting Group have estimated up to $16 trillion real world assets industry by 2030. So you can see the tremendous opportunity, and of course blockchain doesn't just stop there, but that is the current wave that we are seeing, real world assets tokenization. So hopefully from this congressman at the hearing has given you that clarity that you need. And then of course it's very important that you do your own research as to what are the top coin projects that is out there in the real world assets tokenization space within the blockchain arena. I've made some other videos on that as well in my channel. So hopefully if you found today's episode interesting, please hit the like button and share the video to your friends and family and colleagues at work. And if you haven't done so already, so please subscribe to my channel, because I regularly post interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So until next time.